Welcome to this audiobook-style summary of one of the most influential investment books ever written, The Intelligent Investor by Benjamin Graham, the mentor of Warren Buffett and the father of value investing. In the next few minutes, you will discover timeless principles that protect your wealth, guide your decisions, and help you become a true intelligent investor, not a speculator. So, sit back, relax, and let's dive into the wisdom that shaped generations of investors. Chapter 1. What is an intelligent investor? An intelligent investor isn't necessarily someone with a high IQ, insider tips, or fancy degrees. Graham defines an intelligent investor as someone who is patient, disciplined, and eager to learn. Most importantly, they are emotionally stable and realistic about returns. In Graham's eyes, intelligence in investing is not measured by how clever you are, but by how well you control your temperament. The investor's chief problem, and even his worst enemy, is likely to be himself. Most people chase hot stocks and try to time the market. Intelligent investors do the opposite. They focus on the long term, seek value, and stay grounded, even during market madness. Chapter 2. The difference between investing and speculating. Here's a key distinction that sets the tone for the entire book. Investing is when you thoroughly analyze a company and make a decision expecting steady and reliable returns. Speculating is gambling on price movements without understanding the underlying business. For Graham, speculation is dangerous when people do it thinking they're investing. Most market participants are actually speculators, chasing trends, following hype, or reacting emotionally to news. Operations not meeting these requirements are speculative. Graham doesn't say you shouldn't speculate, but if you do it consciously and with money you can afford to lose. Chapter 3. Mr. Market, your emotional business partner. Imagine you own a small business with a partner named Mr. Market. Every day, Mr. Market shows up at your door with an offer to buy your share or sell you his, and his mood swings wildly. Sometimes he's overly optimistic, offering high prices. Other times, he's depressed and offers your shares for cheap. You don't have to act on his offer. In fact, the smart investor waits for the right deal. The intelligent investor is a realist who sells to optimists and buys from pessimists. The lesson? Don't let the market's emotions dictate your decisions. Let it serve you, not guide you. Chapter 4. Margin of safety, your financial seatbelt. The core principle of value investing is this: always invest with a margin of safety. It's like building a bridge to hold 30 tons, but only allowing 10 tons to cross. That's smart engineering, and it's smart investing, too. You buy stocks when they are undervalued, trading below their intrinsic value, giving you a cushion against errors, bad luck, or market volatility. The essence of investment management is the management of risks, not the management of returns. Margin of safety protects you from permanent losses and gives you peace of mind. Chapter 5. Defensive versus enterprising investors. Graham divides investors into two categories: defensive, passive. These investors don't want to spend too much time analyzing stocks. They want reliable returns with minimum effort. For them, diversified portfolios of high-quality blue-chip stocks or index funds are ideal. Enterprising, active. These investors are willing to put in the time and research to find undervalued stocks. They dig into financial statements, industry trends, and seek hidden gems. Neither approach is superior. It depends on your time, knowledge, and emotional discipline. Chapter 6. The role of bonds in your portfolio. Graham emphasizes the importance of balancing your portfolio between stocks and bonds. Bonds offer stability and predictable income, acting as a counterbalance to the volatility of stocks. The intelligent investor adjusts this ratio based on market conditions and personal risk tolerance. A typical range might be 50-50 or 60-40. During bull markets, you might increase bond holdings to reduce exposure. In bear markets, stocks might offer better value. Chapter 7. Stock selection for the defensive investor. For defensive investors, Graham offers a checklist for stock selection. Large, reputable companies. Consistent earnings over the past 10 years. Regular dividends. Low debt levels. Price not excessively high compared to earnings or assets. Chapter 8. Stock selection for the enterprising investor. Enterprising investors dig deeper. They look for undervalued companies the market has overlooked, small cap stocks, turnarounds, or temporarily beaten down businesses. This approach requires thorough research, patience, understanding of financial statements, a strong emotional temperament. Graham encourages investors to find stocks trading below their intrinsic value, based on earnings, assets, and growth potential. This is how intelligent investors uncover true bargains. Chapter 9. The Dangers of Forecasting. Graham warns against predicting the future of the market or economy. Most forecasts fail. Even professionals get it wrong. Instead of trying to guess what will happen, focus on what you can control: your behavior, your research, and your margin of safety. Chapter 10. Inflation and the Intelligent Investor. Inflation erodes purchasing power, and it's a constant threat to long-term investors. Graham suggests that stocks, over time, tend to provide a hedge against inflation better than bonds. Chapter 11. Investing versus speculating in IPOs. Initial public offerings, IPOs, are often hyped, overpriced, and driven by emotion rather than value. Graham advises caution. Most IPOs are promoted when markets are hot, not when value is high. A great company is not a great investment if you pay too much for the stock. Chapter 12. The Investor and Market Fluctuations. Markets rise and fall. That's a given. The intelligent investor uses volatility to their advantage. When markets fall, buy more at a discount. When markets rise, trim positions if valuations get excessive. Volatility is not risk. The real risk is selling in panic or buying in euphoria. Sound familiar? Warren Buffett lives by this. Chapter 13. The Psychology of Investing. Ultimately, the biggest enemy of an intelligent investor is not inflation, recession, or market crash. It's you. Your fear, greed, impatience, and herd mentality are the true obstacles to wealth. Graham's entire philosophy is built on emotional discipline, staying rational when others lose their heads. If you master your emotions, you've already won half the battle. The timeless wisdom of Graham. Let's recap the core lessons of The Intelligent Investor. This isn't just a book about money. It's a guide to long-term financial character. Warren Buffett called it the best book on investing ever written. And even decades later, its lessons ring true. So, whether you're just starting out or a seasoned investor, remember, intelligence in investing isn't about brilliance. It's about behavior. If you found this audiobook summary valuable, don't forget to subscribe, and hit the bell icon for more timeless book summaries on money, mindset, and mastery.